Let's Talk Money.
Welcome back. You're with us on Let's Talk Money, and this week we are talking taxes. It is the new financial year. April has just gotten over, and we need to understand if we've chosen the right income tax regime and if we're planning our investments in a tax-efficient manner. Mohit, I'm going to come to you on this one. Now, pure equity is fine. I mean, we were all living with it, dealing with it, that long-term capital gains is not 10%, it's 12.5%. My question to you really is that, and this is a year where equity markets have been very volatile, right? So people will look beyond equities to diversify their portfolios. So when we get to the hybrid fund category or things like maybe REITs or InvITs, things to diversify, which of these options looks a bit tax efficient to you?
Absolutely. I think, Surabhi, this budget actually has ushered a lot of good news for investors in multiple categories of mutual funds. So if I were to just point out few categories which have really benefited, I think the number one category and which is shining the brightest is gold, silver, the commodities category. Previously, the taxation out there was not as favorable. It was long-term was defined as 3 years. Now the long-term has been redefined as 2 years. And the long-term capital gains is 12.5%. Obviously, there is no indexation any further, but 12.5% after 2 years is a pretty good and a pretty neat deal for anyone who is willing to invest in commodities. So that's, to my mind, the biggest advantage. The second biggest category is the international funds category. There's a lot of interest, a lot of money which has been of late going into US funds, other, let's say, global funds, global themes. So those were all taxed like your debt funds previously. But now again, on those international fund of funds and international funds, the taxation is very clear. Long term has been defined as 2 years and the taxation is 12.5% out there. And similarly, fund of funds category is also something which is benefited and the taxation is same as gold and international funds on that.
So let me ask you this, that's the tax part of it, right? That this is where these categories have become tax efficient. But now also let's, add the investment advice to it. International funds, and not too many are open right now for investing. Gold, after a huge 40% run, is it still advisable? Would you look at these categories for investments this year?
So that's a tricky one, honestly. I think, look, as a diversification tool, both international and gold, I think always merits an allocation in any kind of portfolio. Whether that allocation is 10% to international and 10% to gold, or 10% to international and 20% to gold, silver put together, I think that will completely depend on the nature of the investor, his appetite, risk appetite, and few other parameters. But my sense is, as a portfolio asset allocation, these are core parts and cannot be missed. One needs to have it. However, at this juncture, would I advise anyone to invest more in gold and go over allocate out there? Honestly, not. I think it's not the time to over allocate into commodities right now. Perhaps if you're sitting on some allocation, yes, make the most of it. But it's not the time to add further at these levels. And if you are any which ways over allocated as per your asset allocation, then you might just look at taking something off the table as well.
Okay, all right. So don't get carried away in the gold rush. That's the advice coming in from Mohit. Though there are people out there on the street, targets are ranging up to $4,000 in gold. But that's a debate for another time. Mohit, now back to this whole question of fixed income or hybrid funds or arbitrage funds. I'm going back to the point of asset class diversification. We can't have only equities in our portfolio. We've discussed gold, we've discussed foreign funds or global funds. How to take tax-efficient fixed income sort of exposure in the portfolio?
So honestly, I think finding a tax-efficient fixed income mutual fund option is like finding a needle in a haystack. But you have few needles out there if you are like really keen to find one. So I think there's this new category which is ushered in, which is called income plus arbitrage category. I think the category very smartly plays around 35% composition into arbitrage, and the remaining portion is treated is into fixed income investments, which could be short maturity fixed income papers or long maturity fixed income papers. All fund houses have their own modus operandi to deal with the fixed income paper. But that category effectively gives you a 2-year long-term capital gain taxation, which is 12.5%, and absolves you from the fixed income taxation, which is at your slab rate. So that's one category. The second category, which is not exactly fixed income by definition, but the return profile is fixed income and the safety profile is also closer to fixed income, is arbitrage category, which has been extremely popular of late, and that gives you a proper equity taxation, which is 1 year long-term capital gains at 12.5%. And the third category is equity savings category, which is a composition of arbitrage plus naked equity in the portfolio. Again, will give you a pure equity taxation in the portfolio. So yes, in pecking order, pure fixed income, then you go with income plus arbitrage category, and otherwise you have arbitrage and the equity savings categories.
Okay, great. So those are some examples of maybe some fixed income funds which are not entirely, taxing, so to speak, on our returns and our investments. But otherwise, Mayur, do you want to add to that on fixed income or quasi-fixed income plays? Some people say REITs are like quasi-fixed income, steady income generating plays. So maybe not pure debt. I'm not saying FD or strict fixed income fund, but anything else, stable, safe, and where tax will not bite too much.
Yeah, so if you look at AIF investment in category 1, category 2 are completely tax free in that sense. So there is no tax incident on the earner, the investors. So if you are investing which has such kind of benefit, then definitely you can really look at, because that is purely tax efficient. The reason for that is tax is paid by the fund itself. So there is no tax which has to be paid by the investor then. If you look at category 3, it's a flow through. There also you will have advantage of whatever is being earned by the fund.
Yeah.
So there by default you get advantage because taxation is only at a one stage, then multiple stage.
But you have to invest in big ticket sizes.
That's right.
Minimum threshold I think is 10 lakhs or higher, much higher for many of these funds, right?
That's right.
But that's where the tax advantages are. So for the HNI, ultra HNI, or the affluent category, they could be considered.
Absolutely.
So we've covered a lot of asset classes. This has been a breathtaking rush. We've done equities, fixed income, we've done gold, real estate very, very carefully. Because even in real estate, Mayur, last couple of years, we've seen changes. I think even that reinvestment, if you're selling your house, I think you can now split it across 2 properties, house properties, if I'm remembering correctly. So just again, revisit for us, from a tax perspective, if I want to buy a house this year, is there anything new? I don't think there is. And if I want to sell a house or sell a house property, then how can I plan it effectively?
So when you are selling a house, if it's a long term, there are 2 things. One, with indexation, you want to consider in that situation, you will the tax will have to be paid at the rate of 20%. But because of indexation, if you are suffering any losses, that will not be allowed to be carried forward.
Okay.
And that will be foregone then. But if you are if you are getting tax at 12.5%, then there is no challenge.
Okay.
Now, how do you really save tax when you have sold one property? If the entire gain is reinvested.
And before we talk about that, I just want to, because there was a lot of debate when this was announced, whether you pick 12.5% without indexation or 20% with indexation. Again, what is the final thumb rule that the calculations showed up? When should you consider 20% with indexation, and when is 12.5% better? Is there some math to it?
So it's still an iteration process as of today also, but there is some guidelines around it, and let me explain those guidelines. What happens is that if your gain is much bigger than the expected or inflation rates or in index number, in that situation, I think going for 12.5 without indexation is much better.
Okay.
But whereas if your a value increase is not much, then going with the old method is much better, where you will be not paying any taxes thereon. Though the losses will not be allowed, but you will not be able. You don't have to pay any tax thereon.
Okay.
It is like when we are looking at new regime, old regime, the same 2 rules will have to be applied here as well now.
Okay, got it, got it. So that's the rough rule of thumb. But you were saying that if someone wants to save on these capital gains, they can reinvest the gains as well, right?
Correct.
What are the options there?
So there are 2 options. One is that either you invest gain in another property, and here I am talking about gain and not sales proceeds. But you can invest up to 10 CR and you will get the benefit in that.
Okay.
So if you are investing more than 10 CR, then you will not get proportionally, those benefits will get diluted.
Sure.
Now, when we are really looking at another thing is that you invest in infrastructure bonds. But the investment or gain in their sales proceed invested can be up to 50 lakhs.
Right.
And it does not offer larger advantage. Another disadvantage of that investment will get locked in for 5 years. Whereas in property, investment will get locked in for 3 years.
Okay.
So that is the, that is how you have to analyze. But more often than not, infrastructure bond does not give you good yield. And I'm sure Mohit will be able to answer that.
Okay. Mohit, so last word with you then. Now we've understood the full tax maths for this year, all the rates for this year. So any advice in terms of which asset classes look better, where to book some profit, where to keep, where to increase exposure in general, to wrap up?
Look, Surbhi, as long as real estate is considered, I'm a proponent of REITs and InvITs, and I think the taxation out there is also pretty favorable, which is 12.5% with a 24-month kind of an holding. So my sense is that's a 12-month kind of an holding at long term. So my sense is that's a great way to invest in real estate. But overall, I would still at the pecking order, in spite of the taxes going up from 10 to 12.5, I would still rate equity by far the most coveted asset class, and by far the one which should demand the highest proportionate allocation in any portfolio, followed of course by commodities and fixed income. Depends on the risk profile and the nature, and fixed income can be made tax efficient in a portfolio depending on the outlook of a portfolio, right? So there are multiple ways to do all this. So.
Fabulous, fabulous, gentlemen. I think this has been a very, very helpful refresher, a great crash course, stepping stone to how we can plan our investments and our sort of income streams better from a tax lens this year, FY26. Thank you so much for joining in. Great talking to both of you. Well, viewers, we hope you found this session useful. I certainly did. Keep sending us your feedback, queries, comments. See you next week with another theme.
Let's talk money